Hello and welcome to the show. I am Puneet Wadhwa and we have with us Mr. R Venkataraman, Chairman IIFL Securities with us.
Good morning, Puneet. Thank you for having me on your show.
Let me begin by asking you, do you think that the global financial markets, including India, have overreacted to the likelihood of the US Fed's aggressive rate hike and geopolitical situation with Ukraine?
First of all, I would like to say that if you see the way markets behave, they tend to overreact on both sides, on the good news also, on the bad news also. So as of now, what we are seeing in the world is the Fed rate hike, or the risk of a very fast and a steep rate hike curve by the US Fed. And what happens typically when the Fed raises hike is that as a group, as a cohort, all flows in the world tend to get affected, especially emerging market flows. So clearly what is happening is that people are afraid that emerging market flows across the globe, and since India is a part of the emerging market basket, so that those flows will be affected. Then you have the situation in Ukraine, and effectively what happens is that Ukraine is a real geopolitical issue, simply because it is like going back to the Cold War days of the 70s and 80s before the Berlin Wall crashed. And then Ukraine is very uniquely placed because it is like a transit hub for energy, which is crude and natural gas. So all in all, we have an interesting cocktail of Fed rate hike, very high valuations, geopolitical situation, which can effectively lead to hike in crude and natural gas prices, which again will fuel inflation and again have some kind of negative feedback loop into this interest rate hikes. And clearly the markets are nervous and markets are correcting. But to be fair, the corrections, Ukraine is like, I would say, the last straw on the camel's back, because markets have started correcting sometime in advance on fears of the Fed rate hikes. If you see even the global markets, say NASDAQ and Dow, many stocks are down significantly, although the markets optically are still remaining at an elevated levels. So this is a part and parcel of normal correction, because post-COVID of 2020, we have had a one-way rally in the markets. So typically, when you have a one-way rally in the markets should also correct. So that's healthy for it. So I would say that we are in a healthy correction mode.
So do you see more chances of a downside from the current levels, or we are close to bottoming out?
So on the Indian markets, I think what has happened is that you have two contra forces at work. The first force is, I would say, on the negative, that the foreign flows are weakening, and I think for after a long time we have seen month after month of incessant FII selling. The good news is that obviously the domestic equity flows have improved. We are seeing 10,000 crores of equity SIP, which is actually very strong. So that is a good news on the liquidity front. So we have foreign selling countered by domestic buying. But the interesting thing is that, in my opinion, the real macroeconomic situation in India is improving step by step. And we have a good budget in which the government of India is talking about a huge outlay in capex spending, which again, very good, because that leads to real economic growth over a period of time. But on the other side, we have valuations which are very high level because earnings growth has yet to catch up. And again, India also, like we have seen in across markets across the globe, post the COVID pandemic of March 2020, when the Nifty fell below 10,000, we have had a continuous rally because we had a one-way rally. And so effectively what is happening is that the markets are taking a breather. And in my opinion, that markets will remain subdued. They will wait and watch and see how the interest rate hike scenario works out. What happens to inflation? Because remember, CPI is at 6%, but WPI is at 13%. So there is some kind of gap between CPI and WPI, which the market has to digest and resume the rally once there is clarity on the earnings growth. So short term, I think the markets will remain lackluster. And after the first quarter results of next year, when there will be a clear outlook on how earnings growth for FY23 will pan out, then we'll see a rally upwards. Okay. So on a long term, medium term, I'm quite optimistic. On a short term, I'm not so optimistic. Let me put it this way.
So where do you see the leadership emerge from if the markets has to even sustain at these levels, or move up over the medium to long term from here on?
My guess is that if you see the leadership things, then IT is clearly a good sector to be in, good space to be in. Banking and financial services should do well, simply because It looks as if the NPA problems are behind us, and credit growth will come back to the economy. Capex spending will come back to the economy. Capex cycle again should do well because of the fact that the finance minister talked about a 5 lakh, 7 lakh crore Capex spend. And these are the three segments which I think would do well.
And which can be the sore points?
My guess is that it's not exactly that. The FMCG valuations are very high, and I think FMCG will see inflationary pressures on the cost side, and also valuation. They don't have the comfort of valuation. So that is one sector which I think will underperform. Although the companies in the FMCG space are all very high quality companies, but my only concern in that segment is because they are priced to perfection.
Okay, so how big a dent can rising fuel prices, cause in the FY23 earnings of India Inc.?
That is a very good question. Simply because we have not seen a fuel hike for a long time.
Yeah.
So my guess is that after the elections there will be a fuel hike without doubt, because now crude is already touching $95, and that will obviously have an inflationary push in the economy. So if the overall macroeconomic situation does well, then we will digest it. If that is not done, there's the recovery not there, then we'll have a challenge in our hands.
So how do you think the retail investors are looking at these developments? Are they a bit cautious now before putting in their money?
My overall sense is that the retail investor has shown a lot of maturity in this time around, because most of the money is coming from mutual fund SIPs, because the SIP inflows on a month-on-month basis also at a record high, and we are crossing 10,000 crores very comfortably because of continuous evolution in education, advances made in tech. So the retail investor is behaving quite, I would say, sensibly.
So what has been your strategy in terms of investment across sectors in equity and debt over the past couple of months?
See, in the debt side, we are suggesting to look at the shorter end of the cycle, simply because the rate hike will happen. So if you have a long dated paper, then obviously you'll get hit. So either you look for a fixed tenure kind of thing, or look for short term and wait for a better opportunity to enter. On the equity side, we are recommending our customers that you should, first of all, pare down your expectations, because the last 2 years we have got 20% plus growth. The mid cap had done very well, so that kind of returns will not happen. So A, have rational expectation of returns, and B, continue to remain invested, simply because the macroeconomic cycle is going to turn.
How are you planning, your portfolio strategy in this backdrop?
See, our feeling is that we look at an overall asset allocation based upon the individual client risk profile. So we don't have one size fits all. Second thing is that we don't recommend investors to sit in cash, because the cash allocation is done at the investor at his level. So we recommend that we should have our recommendation, which was earlier overweight on equities, has now come back to at par or slightly below par, and we are telling people to wait for a better opportunity to enter.
How do you think the LIC IPO will play out? Can it be a threat to the secondary market liquidity?
See, LIC's IPO will be one of the biggest events in Indian capital market history. So maybe after 10, 15 years, when people look back on the history of capital markets, then LIC will be a big event. It's a big event because it's a large scale, 65,000, 70,000, whatever crore issue, which is the largest issue in terms. Second thing is a big ticket divestment by the government of India. And C, LIC itself is a behemoth. It is an industry leader with about, I think, 60-65% market share. And it's the largest asset manager in the country by far. And it's like a brand which is known to every nook and corner of the country. So it will be a big event. But my guess is that the 65,000 crores of liquidity suck out what you are saying will happen. But that the market will digest in a matter of maybe a month, and then come back. But it will be a big event in the Indian capital markets, without doubt.
Which actually brings me to my last question. Talking about IPOs, a lot of those companies that actually hit the primary market and got listed, the new age ventures, so to say, are trading massively below their listing price and issue price. One, what do you make of this? And two, do you think that retail investors now would have learned a lesson to look at the fundamentals first, and not purely go by the hype that is created when the IPO is launched?
See, actually, if you look at all the fintech companies which got listed, and all of them are trading low. So effectively, what has happened is that most people had invested in all the IPOs because of previous track record of IPOs getting listed in a huge, what is called as a listing pop. Now, this time around, the listing pop had not taken place. So many people are obviously not happy with it. And so what has effectively happened is that the new age companies which are there, all of them were very sensitive. My guess is that all of them were sensitive to growth expectations and interest rates, because the bulk of the valuation is coming from terminal value, which is very sensitive to interest rate. So as the interest rate started going up, these fintech valuations started shrinking. Second thing is that it is not an India only phenomenon, but world over, these companies, Indian fintechs which got listed, were compared to global peers, and those global peers are also down significantly. If you see the price of Twitter, Robinhood, all of them are down significantly. So it's a combination of both these factors. So obviously some of them will emerge as big market leaders in the future, but at this point in time, my advice is that to wait and watch and see how the actual game plan and how these companies evolve before jumping into this.
Thank you, Mr. Venkataraman, for joining us today.
Thank you so much, Puneet.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.